How to read a chart as a day trader. Part 1. Understand the market context before you trade. Hello everyone. Welcome to Net New Universe. Today we're starting a new educational series on how to read a chart correctly as a day trader. But before we continue, if you are not already subscribed, please go ahead and like and subscribe to my channel Net New Universe so you don't miss the upcoming videos like this. And before we talk about indicators, entries, candle patterns, or trading strategies, I want to start with something much more important. Do you actually understand what the chart is telling you before you enter the trade? Have you ever entered a trade believing the market was going up, and almost immediately after your entry, price started dropping? You watch your position go negative, the loss gets bigger. Eventually, you can't take it anymore and exit for a significant loss. And what happens right after you exit? The market turns around and starts moving in the direction you originally expected. I've had that same experience too. And sometimes the problem wasn't that our directional idea was completely wrong. Our timing and our understanding of where the market opened were wrong. As a day trader, you cannot simply open a chart at the opening bell, look at a couple of candles, and decide whether the market is bullish or bearish. You need to understand the story that brought price to where it is right now. Start with your higher time frames. Look at the daily chart. Look at the weekly chart. Understand the larger trend and where price is trading within that structure. But don't stop there. How did yesterday's session behave? Where was yesterday's high? Where was yesterday's low? Where did yesterday close? Was yesterday trending, consolidating, recovering, or selling off? Then look at today's pre-market session. Where is the pre-market high? Where is the pre-market low? Did the market move significantly overnight? And most importantly, when today's regular session opens, where is that opening relative to all of these levels? Are we opening above yesterday's range? Below yesterday's range? Inside yesterday's range? Near yesterday's high or low? Or are we opening with a significant gap from yesterday's close? These questions can completely change the way you interpret the first move of the day. For example, imagine the market gaps higher. Someone looking only at the opening may say, "We're opening higher. This is bullish. I'm buying calls." But you studied the chart before the market opened. You know where yesterday's levels are. You know what happened during pre-market. And you recognize that today's opening is already sitting near an area where price could face resistance or rejection. Now you have a completely different perspective. The larger trend may still be bullish, but that doesn't mean price has to go straight up from the opening bell. The market might first reject that opening level. It might retrace several points. It might move toward the previous session's levels. It might consolidate. And only after that does the actual bullish move begin.
This is where many retail traders get trapped. We see the gap, we see the first green candle, we see price moving without us. And suddenly, FOMO takes control. I need to get into this trade before I miss the move. So we buy. Then the completely normal opening retracement happens. Our position immediately goes negative. Now another emotion takes over, fear. And if we've already lost money on previous trades, another emotion can become involved, revenge trading. We're no longer patiently reading the chart, we're trying to recover what we lost. That combination of FOMO, fear, impatience, and revenge trading can destroy a day trader's account. So how do we reduce this problem? Give the market time. You don't have to trade immediately because the opening bell rang. Let the market establish itself. Watch how price reacts to the opening level. Watch yesterday's high and low. Watch the prior close. Watch the pre-market high and low, and see whether those important levels are being reclaimed, rejected, or broken. Let the market provide evidence of its actual direction. Then look for your confirmation. You may occasionally miss the very beginning of a move by waiting. That's okay. As a day trader, you don't need every point. You need a high-quality portion of the move with a clearly defined risk. And when you finally have your confirmation, consider starting small. Don't immediately jump into your maximum position because you think you found the direction. Start with a manageable position. See whether the market continues validating your idea. If the setup develops as expected and your trading plan allows it, you can consider scaling afterward.
Remember, your job isn't to predict what the first candle will do. Your job is to understand where the market is, where it came from, how it is reacting to important levels, and then wait for price action to confirm your trading idea. So before your next day trade, read the chart in this order: higher time frame, previous session, pre-market, today's opening location, reaction to important levels, direction confirmation, and only then, the trade. The market will always give us another opportunity. Protecting our capital and waiting for the right setup gives us the ability to be there when that opportunity arrives. This is part 1 of my series on how to read a chart as a day trader. In part 2, we'll add another important piece to this process and continue building our chart reading framework step by step. This content is for educational purposes only and is not financial advice or a recommendation. Trading stocks and options involves significant risk, and even strong setups can result in losses. Always follow your own risk management rules and risk only what you can afford to lose. Please don't forget to like, share, and subscribe to Net New Universe for more educational videos like this.